this year and next year, between 24, 25, and 26, you have 15 trillion of that coming due, okay? All right, well, you got to refinance that. And when you go to refinance that, you have to remember that that's called a hedge on what they do on the dollar. Like if the dollar stays strong, a lot of foreign countries that have dollar-denominated debt, they'll sell that stuff. They'll sell the bonds because they're like, hey, I got to pay off in dollars. So it creates a lot of downward pressure on the price, is what I'm saying. And maybe there's a way for them to get out of it. I'm sure eventually what will happen in the long, long run will be like.
You're watching Capital Cause, and my name is Danny, and today's guest is Ted Oakley. Ted, thank you so much for making your return on the show.
Thanks a lot, Danny. Good to see you again.
Yeah, likewise. Let us just dive right in, Ted. What is for you the most topical thing right now? If you were to pick anything out there in regards to the economy, investing, etc., what would be most topical for you? What's the top story?
Well, Danny, as you know, we really look at companies from the bottom up. But if I were looking at the top down, I would be looking at what's going to happen with the new group, President Trump's group coming in, and how they transfer everything they want to do into what I call real life. Therein lies the problem, because there's certain ways you could do that might not upset the economy and the GDP so much, and then there's certain ways you can do it that would be more negative. And you hope that they can figure out what they need to do if they're going to do that. Yes, but there's ways that you can do things where it gets really ahead of itself and causes sometimes short-term damage that you didn't expect. Similar to what happened with Reagan when he came in, President Reagan. He came in, and from the day he was basically inaugurated, we had a 19-month bear market, all the way to
unintended consequences.
1982, yeah. So you have to be careful. That would be what I would be looking for, yeah.
So based off of what Trump has kind of told us and some of the language out there and some of his cabinet picks, what are your expectations, so to speak? Things can go across a wide band of possibilities, but if you were to pick a base case, what would that base case look like for first year for an upcoming Trump term?
Well, you have to think this time the man is going to have a lot of changes take place rapidly, because he knows what he's doing now, and he's got all these people he's going to put in place. So I assume there'll be a lot of changes in a hurry. I guess that's the reason why we look at individual companies, because since I can't figure that out, I can figure out what a good buy is, but I can't figure out necessarily what's going to happen, in terms of where we go politically in the country.
I see. And what kind of companies, what kind of businesses, what kind of sectors do you anticipate really piggybacking off of the coming Trump term?
Well, I still think, the commodities sector, really not only during this term, but during the next 10 years, will come alive again. It's sort of been hit or miss a little bit in 24, but I suspect that natural gas, oil, to a certain degree, the metals, and all that sort of thing, they'll move forward and get more traction than we've had. I think people understand that a lot of the metals that we need, particularly precious metals, that sort of thing, we don't have enough of those, and we're going to see more of that. I think that's the way things will go. I suppose we'll see, but it looks like there'll be a lot of activity in those two areas.
So that rings as good news for us commodity investors, but it would portend a bad news for Trump and I guess the rest of the citizenry that isn't invested in commodities. Is this kind of foretelling supply side inflation coming down the pike?
Well, we thought all along that inflation would now go to another level as opposed to where it's been. I mean, that period from really 2009 until 2022 was a very abnormal period. That if you look back at the history of money, that's never happened.
Mm.
It only happened because of the way they did things really
Are you
affected.
referring to the spike in M2 money supply?
No, I'm really referring to where we were in terms of really, really low inflation.
Okay.
And it was one of those things where that was going to create some problems down the road, but we should be running, you know, if you look at it, the only thing you can use really is CPI or PPI, but that should be running now on normal, you know, 3 to 4.5 or maybe 3 to 5. It's going to go back like it was. If you look at that period going all the way back to like 1960 or so, early 1960s, through the period of say, the end up to 90, you had a period there where the average was about 4 points or 4.25. And I think we'll go back to that. And if you go back to that, then inflation is going to be a factor here. And I think it'll be a bigger factor than people think it is.
Yeah.
Maybe not in the short run. If things slow down, the economy breaks down, obviously it would fall back. But I'm just saying over a long period of time, 5 to 10 years, I think you've got to bet on inflation being higher and interest rates being higher.
You're already kind of starting to see that with the rising oil price and rising nat gas price, haven't you?
Well,
And
you're certainly
in the
seeing
last
it.
week.
Yeah, yeah, in the wintertime. I mean, we haven't seen natural gas at $4 in a long time. But I think the bigger situation is going to be where you got a problem with the Federal Reserve has this problem. They are running into the problem of the U.S. government debt. Those two combined will be where you're going to have some sort of policy that addresses that, because I personally think that the long rates will go up. Like you're almost at 5 today, right at 5 on the
Right.
30-year bond. I think they go up over 5 to 10 over this next decade, whether they lower rates or raise rates. Either way.
And what does that mean? What does that spell for the average person out there?
Well, I think the average person has to realize that know what we've said this all year long. You need to know what you own. And one of the things that we have espoused really, and it paid off, it's really paid off for us over a period of time. It hurt us during the 2021 period. We had real short maturities, so we didn't make as much money, but it helped us because we never got hurt during the rise in interest rates. You've got to keep your maturities short. If you're buying 20 and 30-year paper, I think you're making a wrong bet here for the next 10 years or 20 years. And that's just something that we feel like the average investor doesn't realize, but they're buying into bond funds that buy that long paper, and we just don't think that's where they should be.
So we just got new PPI numbers for wholesale prices, rising 0.2% in December, albeit less than expected. What do you make of those numbers for wholesale? And then I believe the prior CPI numbers was just at around 3%. I can't remember exactly. I could be wrong, but just a
Mhm.
little north of 3%. So uh, inflation numbers appear to be a little subdued, but you're calling for a little bit more price action to the upside when it comes to prices for the consumer and wholesale producer.
Well, I think it will come back to the monetary more than what we're looking at there on those sorts of things, because what happens eventually is we're at this level now where debt to GDP is 120%. And so you're in a situation where foreigners own a lot of our bonds, you know, and they're probably going to sell those bonds because with the dollar going up, that means everything they owe money in dollars is hurting them. So they've got to make some adjustments. And I think that affects the rates and what I'm saying. But I think that also works itself into where everything will have more inflation as you go up. Yeah, it's going to come and go. I mean, there's no question about that. And I've said all along that if you get short term down, and we thought you could get interest rates and inflation rates low in the short term. You could, because things might slow down enough to do that. If that happens, don't take the bait, is what we're saying, because it won't last. In our opinion, it won't last. We'll go back to normal, which should be, again, 4%, four and a quarter. It should be higher than where it is now.
Interesting. Can't you make the argument that the CPI is for lack of a better phrase, a garbage in, garbage out formula? Saying that we're only up 3%, but the average person can look at their grocery list. They can see that it's way up. It's way up more than just 3% annually. You have things like hedonic adjustments, substitutions that can kind of deflate the number back down. How much weight can we really put on these metrics?
Well, I'll just give one example. If you take beef, for instance, which has really been on a tear on the upside, if you look at it, people, and they may say, well, we're going to substitute chicken or turkey or something for beef. But in reality, the average person doesn't really do that. They still want a hamburger.
Right.
They still want a steak once in a while, and they can't substitute chicken for that. And I think that's I think that's where the misnomer comes in. You can show that CPI all you want to, but what you really should show is the same basket of goods you buy every single time, because then you really know what the average person is going through. And I think that's where the misnomer comes in.
I see. And would you say that are we in a stock market bubble right now, or is there still more upside to go? Because we've had doubters and crash enthusiasts for quite some time calling for a market top. And it just keeps going higher and higher. Are we at a market top in your opinion?
Well, I'll just give you a statistic.
Sure.
I mean, if the forward earnings of the multiple of the S&P is 21 and a half to 22, your average return over the next 5 to 10 years is only about 3 or 4%. So no, you don't have any upside. And if you think about it, and I try to mention this to people, but if you take the earnings yield, which is basically flipping, the price earnings, and it's the earnings return against the price of the S&P 500, it's lower than the Treasury, than the 90-day Treasury. So they're not paying you. What they're basically saying is the risk part of the market, the S&P, is not risky, which is not true. And so I think people have to realize if you're looking at a multiple earnings of 24's earnings, it was about 25 times, 24 and a half, or 22 times 25. And I think that's where people don't realize that's well above the norm. The first time that President Trump came into office, we were barely 16 times, about a 15.8 times. So there's a big difference now between that and then. So the upside's limited. You can see that in companies, though. We look at a lot of companies, okay? We have about 250 companies we'd like to own if we could. We don't own that many, obviously. And we can always tell by the length of that list how cheap the market is. And there's not many good buys on that list right now. There's some, but on a relative basis, if you have a period like April of 2020, where we had 90% of them are good buys. See, there's a difference in which you can see it with the companies, and that's the way we look at it, really. But I'll tell you, the market's expensive. You can call it whatever. You can call it a bubble. I will tell you this, that if you look at pensions, they're at an all-time high relative to their exposure to stocks. I've had the graph. I'd show it to you. But I'm talking about going back to 1950. They're at an all-time high, something along the line of about 85%, okay? And then if you look at individuals, they're an all-time high exposure to stocks. I'm talking all-time high, not just recently. And so everybody's in it. And the only thing, and I feel for people, particularly over 60, because they probably have too much in stocks, and they don't realize it until it's too late. And then something happens, and then they're in a pickle, And I think that's what happens with people when you've had really good returns for a number of years without any major bear markets, which is what we've had the last 14 years. And they just get used to things being good, and they forget that, hey, I'm playing in a risky business here. I really need to know what I own. And right now, they all own the same thing, all of them. They all own the index or the S&P 500. the Mag 7. Everybody's in the same thing. I call it the one button ownership because they can sell or buy on a one button click. And it's okay on the way up, but it's tough on the way down.
And the way down happens a lot faster than the way up.
Yeah, you're right. You know that old saying, you go up on an escalator, but you go down on an elevator. That's about right.
Or even lack thereof. You just jump out the window.
That's true. We see some of that too.
Yeah. So you mentioned that you're bullish on commodities, but aren't commodity stocks still stocks at the end of the day? Can we really count on them to be insulated from a correction, from a crash, from a topping market? What's your view on this?
Oh no, it's a good question, Danny. No, you can't. You know, in a bear market, everything goes down. I don't, there's nothing in a serious bear market, okay? The only thing that doesn't go down is the treasury.
Hmm.
Now we own a lot of treasury though. Let me just say, in all of our three strategies combined, we have about 50% exposure to treasuries, all less than 24 months, by the way. So we have a high exposure to that. But you can't protect people try to do I've seen this over the years. They try to do various strategies that I can do this, I can do that, I can protect. But when the downside comes, it seems like there's no place to hide unless you're short, and we don't short for people, but that would be one way to do it. But I'm just saying that liquidity is the key. If you want to have some protection, you have to have some safety or a safety valve. But you're exactly right. They all go down. I could, even the best stocks, the cheapest stocks now, they would get cheaper. That's okay for us, by the way, because we looked at it as opportunity. I don't look as a negative. Um, the lower things go to get really, really cheap, then we really get excited because that's when we want to be fully, fully invested and really have a lot of exposure when things are dirt cheap.
Yeah, I believe it was Warren Buffett that recently released his cash holdings to be somewhere around the 30% marker, which is an all-time high for him. So the fact that he's betting against the stock market in such a huge way that he's never done before, that in itself is very telling. But then by that same token, he did buy more Oxy stock, Oxy Petroleum. What do you, I mean, I'm not asking you to get into the brain of Warren Buffett, but if you were to guess what his strategy is there, what would you say?
Well, I'm sure he's looking at it like we look at it. And now we don't own Oxy because they have a lot of debt and it's not something we own a lot of energy though. Let me just
Mhm.
say to you, we own Exxon, we own Sunoco, we own Suncor, we own Conoco, we own different companies in the
Right.
same business, by the way. But what you look at there is what's going to be the demand for that product on an ongoing basis. And I'm sure that's what he's looking at. That has to be there. And I think you'll find that the current price on Oxy is probably lower than his last buy was, that I remember. I know he has some higher than the price right now, but all I'm saying is that uh, during period, you're always going to need energy, and a lot of the energy companies, I will tell you, they got scared in the green situation, and they cut back. They sold off. They decided, hey, we're going to get out of this because they're coming at us, and we don't want to do this, which meant that the people that were left that were doing the good work were probably going to make a lot of money over the next 10 years, and I think that's where we are right now.
Hey guys, quick pause. As you know, we are big proponents of physical gold and silver on this channel. However, the conundrum often arises, where do you put it? Do you put it in an above ground safe where it becomes a target for burglars, intruders, etc.? Or do you bury it underground? This is where Dirty Man Safe comes in. This is a very simplified solution if you want to bury your gold or silver or actually any valuables underground, whether it be alternative car keys, house keys, paperwork, legal documents, anything that's important to you. You can put in this bad boy right here. Let's go ahead and take a look at how it works. All right, so you're gonna start off by digging a hole underground, sticking the tubular module in with the safe inside. You bury your valuables, and then whenever you want to extract it, boom, there it is. There's a string attachment. You just pull it out, bada bing, bada boom. Check it out here. You have 3 different sizes: the girl safe, the man safe, and the old man safe, depending on how much you want to store in this thing. It's all about distribution. You want to diversify where you put your valuables. You don't want to just put them all in one place. And for more information, also click the link down below. All right, guys, let's get back to the video. And so we see this bottleneck from the producer side. Despite this dwindling, despite a weakening demand side as the economy continues to weaken, you see more supply side destruction than demand side destruction. Is that correct?
Well, I think so. I think, you have to look at it right now. There's so many companies that are public now. Something like 8%, 9% of the really big companies and like 40% of the small companies are profitless. They're not making any money. And, there's so many things have to come together. A lot of that has to get washed out. You can't go on forever not making any money. And I think of so many of the norms that people thought were norms in that 12 or 14-year period that I'm talking about are not really norms at all. That's not the way the game works. Or they just haven't been around long enough. And I think that's going to be the big, what I call, I'm giving a speech tomorrow, by the way, called the Great Reset. And the Great Reset is this. It's going to go back like it used to be. All that period there, those ultra low rates, quarter point interest rates, all that sort of stuff, easy, that's all gone. You're going to have to go back to, running a normal business. And to me, that's will be the problem in the next 10 years.
Yeah, because I don't think we have a generational cohort that's actually experienced that kind of environment.
Oh, not at all. I have a interesting study that we have about what people think is the right amount of income and the right amount of net worth to have.
Mm-hmm.
Well, guess who is off the charts above any other group of people? Millennials, boomers, anybody. Z's, Gen Z. Yeah. They think that they should have 10 million in net worth and make $560,000 a year. That's their idea of success.
Is that a real number?
No, that's what I'm saying. That's their idea of success. The real number is probably 80 grand. I mean, but the point being is that you've got this whole group of people that have experienced really easy periods here, and so they don't know any better. And so in times, and we haven't had any hard times. You think about it, from 2009 until now, we had a 5-week bear market in 2020. We had a 9.5-month bear market in 22. And everybody's like, well, it doesn't make any difference. I see all the comments. People say, well, yeah, I know, we might get some selling, but we'll go right back to a new high. Well, you might not, okay? 2000 to 2013, you know what the S&P made? Nothing. I mean, you go through periods where nothing happens. I mean, and so I don't know that investors are ready, particularly older investors. I don't think they're ready for that. And I think they don't understand that they need more cash flow than what they're probably thinking about. And that's what you get in a lot of the commodity companies, pay pretty good cash flow. So you got to keep that in mind. Don't get me wrong. We're not skewed totally to commodities. When we own fertilizer companies, we own companies that do metals, but we also own a lot of growth companies. A lot of, we've owned Visa and MasterCard for, forever, a long, long time. They're great companies, cash cows, but there are a lot of the companies today that we wouldn't buy. You take, we have holdovers, for example, for some Apple, but Apple is not really growing that much. And this company's probably done as far as the major growth they had, but they're pricing it like it's going to be a major growth company over the next 5 years, and it's priced incorrectly.
If you had to bet $1, and I'm sure you bet more than $1 on this stuff, but if you had to bet $1 as to which sector outperforms in 2025, starting from January 1st up until December 31st, what sectors do you see, or what sector let's narrow it down a bit. What sector do you see as having the most potential?
Danny, that's a hard question because I don't really look at sectors that much, and I really don't know how to go out for the whole year. But if I had to just look at the next 3 to 6 months, I'd have to think that the gold miners and energy companies will probably do better than some of the others. Healthcare will probably get a bounce. It probably won't be as bad as people thought it was going to be, but I'd say those two others will probably see something that they haven't been damaged too much, and I think they'll do fairly well the next 3 to 6 months. For the year, I don't know. I'm horrible at picking things that go on a year or two from now. I can
Yeah,
only look at what I've got right in front of me right now.
gotcha. Well, we have been talking about this topping um, of the stock markets, and I can't remember who said this phrase, but I've heard this metaphor before. The market is like a big house party, and ideally, you want to leave the house party. You want to be walking back home away from the house party as soon as you see the cops coming down the road to break things up, right? You want to be on the sidewalk walking back by the time you see the cops. How much how much duration do we have left in your mind, do you think, until we do hit a top here? And then how much downside do you forecast in the markets if and when we do correct back down?
Well, if you just look at the averages, okay, and again, we look at the bottom up, so we don't look at the average as much. But if you just look at them, they've been going down now for a while, and they'll rally like yesterday. I mean, like this morning, and then they'll turn it around by the afternoon. And they're all below their 50-day averages now. Not that I look at that a lot, but I know other people look at it, so I look at it to see what they're thinking. Um, and so they're below those 50-day averages. They're probably headed lower, in my opinion, at least. And it's hard, if nothing else, it'd be hard to have after 2 years like 23 and 24. It's hard to get another year like that. Again, if we found a really, really cheap company, we'll buy it, no matter where the market is. But we're just not finding that right now. So it's one of those things where, we'll wait until we see the right prices and then we'll do something. But it wouldn't surprise me any time this year to have a 20% sell-off or more, maybe more. I mean, that's not that big a deal, really. Even that doesn't even get you back into, if you figure you're at 22 times earnings, you get a 20% sell-off. You're not even back to what we consider an average market multiple, which is like 15 times. So you got a lot of spread here. If something happens, and we've been able to sort of pull a rabbit out of the hat and keep this money flowing the last 2 years, but we'll just have to see. But I think this year will be tougher.
Mm. Now, you mentioned the gold miners as one of the sectors that you look at fondly. What about gold in general? Where do you see gold in the coming year?
Well, people probably don't realize this, but gold was almost exactly the same return as the S&P 500 was, maybe a little bit better, but it was right on the money. I mean, and people think about that and they think, well, if I bought gold alongside the S&P 500 in 24, we'd have made the same amount of money. And we would never buy that much gold, but I have to think that, and I've watched this with individuals. They've been selling the exchange traded funds that hold gold. They've been selling them. They're leaving, okay? But if you look at the foreign countries, they're buying. They're buying gold, and they're adding gold to their coffers. I think they're adding it because of the dollar. They don't want to be tied as much to the dollar, but they're buying it, all these other countries. And so I think there'll be a demand there for it. And gold itself, if you remember, I'll just use '08 as an example. It went down. It didn't go down until the end, but it went down. But it came right back, came back about as fast as anything did in '09. And so I think gold itself will have a pretty good, and a lot of that goes back to, again, what do you want to own if they get into trouble, this financing thing, I'm talking about what we've got coming
Mhm.
due, and I could go into that, but we have so much money coming due that we've got to finance in the U.S. government, okay? That if they get into trouble and do that financing the wrong way, and we'll see what happens, gold will probably be the one thing that does hang in there. We'll have to see how it goes, but I think that's the problem they're running into. You got to remember, right now we're in a situation where just tax receipts alone go to really pay down just the interest and a little bit of the debt. I mean, we don't have any other room. We're debted up right now, 120% of GDP, government debt.
Right. So go into the financing issues with the United States. What else do you see going on there?
Well, you have to think about it like this. We have so much money. What happened was under Treasury Secretary Yellen, she basically quit buying long paper, okay, long bonds, or selling long bonds. I shouldn't say buying, but selling long paper. I'm talking about 30-year paper. The reason being because I personally think it was political that they didn't want interest rates to go up, okay, on the long end, because that would cause a lot of trouble. And so they sold everything they sold, a lot of were just treasury bills, like 90-day, 6 month, few 9 months. That got sold instead. So this year and next year, between 24, 25, and 26, you have 15 trillion of that coming due, okay? All right, well, you got to refinance that. And when you go to refinance that, you have to remember that that's called a hedge on what they do on the dollar. Like if the dollar stays strong, a lot of foreign countries that have dollar denominated debt, they'll sell that stuff. They'll sell the bonds to, because they're like, hey, I got to pay off in dollars. So it creates it creates a lot of downward pressure on the
Mhm.
price, is what I'm saying. And maybe there's a way for them to get out of it. I'm sure eventually what will happen in the long, long run will be like it always does. We'll run inflation higher than what you can make with what the Fed will set the interest rate, but it'll be lower than inflation. And that's how you'll get out of this trap.
Would a scenario like that offset the dollar milkshake theory? Because yes, countries do need to pay off their debts in dollars, which is a tailwind for dollar demand. But if they end up selling their treasuries in the process to get a hold of those dollars, uh, what's the kind of like the dichotomy there?
Well, I think the biggest thing is that they can't afford, at least the way I see it. And again, I don't spend a lot of time on this. I'll usually look at companies, but I think you have to look at, well, what happens. What happens if you continue to have a strong dollar, okay,
Hmm.
and these other countries, then it creates a lot of havoc. And so all of a sudden, it's going to put pressure. It puts pressure on the bond, is what will happen. But then we have to refinance. We have 7 trillion or so, 7.5 or so. We have to refinance just this year. So, you have to do something with that. I don't know how they plan on doing it. We'll have a new treasury person, Mr. Bassett. So I don't know what his thoughts are. I know a little bit about him, but not enough to have an opinion. But the problem we have is we have too much, and it's all short term, and we've got to do something about that. And when you get into that sort of thing, and you can't drive it higher. In other words, if you go in, and that's what I'm saying about these policies, if you go in the way we look at it right now, if you go in and do the four policies or so that this administration wants to do, which is, don't pay any tax on Social Security, go back to the old tax cuts the way they were, give a business break to 15%. There's four things that adds 30% really to the deficit. Just that alone. There's no, go look
Wow.
at where the money's spent. There's nowhere to cut. I mean, without people screaming. And that's the problem you run into, is all of a sudden you're sort of between a rock and a hard place. And I think that's where we are right now, financing wise, for the US.
And how do you see the effects of tariffs coming into place? I mean, granted, Biden did not remove any of the tariffs that Trump put in the first time around. Yeah, I think he actually expanded a few,
Mhm.
if I understand it correctly. But with Trump adding in more tariffs into the mix in the second term, what are some of the ramifications of that?
Well, Danny, if you look at a historical graph on tariffs, they've really gone down and down and down, and they're at really it's sort of at the lowest point. I mean, we have some tariffs. Don't get me wrong, but it's not anything where it was, many years ago. And I think one of the things that people don't understand is that it depends on how you do that. If you're going to come in and say, okay, across the board, we're going to do 10% or even 5%, then all of a sudden inflation's back. Okay. And we keep saying this, but a lot of these things lead back to inflation. They really do. The bond financing, all these sort of things makes things go higher in terms of inflation. And I think that's the biggest problem with it. And, whether it's a negotiating tool or they really do it, I don't know. I'm assuming they'll do some, but we have some interesting situations. I mean, you look at our neighbor to the south in Mexico, that's 23 or 24% imports. That's a lot. You start really moving that around. And so I hope they can think about it the right way, but who knows? Again, that's an unknown until we get into this year.
Fascinating interview here, Ted. Anything else you want to talk about before we wrap things up?
Well, not really. The only thing I tell people is, we own specific companies and specific bonds. We don't own the funds. But one of the things I see out there a lot is that people are very, very complacent in their ownership of financial assets right now. They just don't seem to understand that, it's like a piece of real estate. I mean, I've talked to a lot of investors that know real estate pretty well, and they know when they wouldn't buy a piece of real estate. But on the other hand, they're over here invested in the stock market as if there's no risk in it, and it's the same thing. And so we always tell everybody, you need to stop and think about where you are. And if you're the upper end of the risk spectrum, you need to balance out. You need to have some balance in terms of having some safety valve because it's too late after it happens. And I think people have sort of forgotten about that because of what's gone on the last 15 years, but I think they'll remember it when the time comes.
Awesome. Well, where can people find you and learn more about what you do here, Ted?
Well, the best place to go is oxbowladvisors.com. It's our website. Really, everything's there. We don't hide anything. You'll see any newsletters or we put out a quarterly, really talking about what we think, where we are, what we own, different things. And so you can find anything there, a number of books there. If you like a book, we'll send it to you too. But that's the best place to go.
Great. We'll have the links to those down below. So check them out, guys, if you're interested. If you enjoyed this interview, remember to give us a like and comment Go, Ted, Go in the comment section. If you disagreed with any of our takes, go ahead and write your comments down below. I do read the comments, so drop them down below. Subscribe to the channel so you don't miss an episode, and check us out on Substack at capitalcosm.substack.com to get uncensored, ad-free, and early access to all of my interviews, along with a chance to ask my guests questions down the line, as well as making guest recommendations for future shows. All that and more. Check us out. And with all that said, I'll catch you guys in the next episode. Bye, y'all.